Hey everyone, before we get into today's episode, I want to take a second to acknowledge Vouch. With over 4,000 startups insured, from napkin sketch ideas to large IPOs, Vouch is the insurer of choice for crypto companies, including L1s, L2s, DAOs, protocols, and a whole lot more. Their exclusive coverages are enhanced for crypto, covering everything from regulatory defense to smart contract vulnerabilities. With Vouch, you're not just insuring your startup, you are investing in peace of mind so you can keep on building. You'll hear more about Vouch later in the show. All right, everyone, welcome back to another episode of Empire. We have Sandeep, one of the founders of Polygon. So Sandeep, man, welcome to Empire, my friend.
Yep. Thanks, Jason, for having me here.
Yeah, of course, man. So what I want to talk about today is Polygon 2.0, which is super exciting. And the way I was thinking about prepping, like doing a little prep for this episode, and was reminded by how much you guys have going on at Polygon, right? You have Polygon Proof of Stake, right? The Proof of Stake network. You have Polygon, the ZK EVM. You have Polygon Maiden, right? You have Polygon Supernets, which is kind of the like app chain focused scaling solution. You have Polygon ID. And then you have like what I think a lot of folks who listen to Empire know you for, which is like these crazy big biz dev deals with, you know, folks like Reddit and I think it was maybe Nike too, and Starbucks and folks like that. And it seems like your goal for Polygon 2.0 is bringing this all together through this kind of network of zero knowledge L2 blockchains. So I think what would be helpful here is, before getting into the what of Polygon 2.0, I'd love to get into like the why of Polygon 2.0 and why this is it feels like the culmination of all of your work the past 5 years. Would love to hear about that.
Yeah, I mean, I think that the why for us has remained always very, very it has been very, very consistent, and that is, how do we create the Web3 infrastructure for mass adoption, right? It might sound cliched because of the last 4 or 5 years, because we are all stuck in the same same stage where everybody keeps saying that we want to see mass adoption, mainstream adoption, and whatnot. But here we are now, where we still don't have a lot of good applications built on Web3. But basically, the goal is that from our side is to create that infrastructure. I would argue that we don't have dApps because we don't have scaling as of now. None of the chains or none of the applications that you see today, or people keep saying that there is so much of block space, but where are the applications? None of these actually, none of the applications have that kind of scalability. Like, if any one of them goes really viral and starts having like 1 million, 2 million daily active users, that app alone will break the chain, whatever that app is, or whatever that chain is. So that's why, the quest is that we create this infinitely scalable blockchain infra, where people can develop these trustless applications and grow it to multi-million users. So that's where that is the why of that. Like, why is, yes, like, we believe that Web3 is basically the next evolution of humanity, like how we conduct our businesses, like how we live our lives in these digital worlds for most of the times. And all our digital life is controlled by some institutions which are in the middle. Like, in this case, we are recording, let's say, via some third party, online podcasting, or you watch YouTube, or you're on email. Everywhere there is a middle party and big institution involved in between. And we all know that how much the low trust environment has got created in the past few decades. So why Web3? Obviously, we seem, or we expect this new trustless era to come in, wherein like applications or our digital lives that we are living, we can live this life more trustlessly. And and hence we need an infra which can actually accommodate, let's say, 100 million users, 100 million daily active users, right? And for that, I don't think any infrastructure chain or anything is ready. And Polygon 2.0 is our attempt to consolidate all the kind of different parts of the research that we have done, whether it's like it was of the Polygon POS, which started as a plasma, or with the ZK, which includes like different kinds of like, EVM, non-EVM, like Maiden, for example, is non-EVM, and all of these things coming together in like a environment which has consolidated liquidity. Because what we are building is this whole ecosystem is about building these financial rails for this new age finance world. Like right now blockchains are still primarily confined towards the financial use cases, and these financial use cases need this modern environment, and we need this environment to be infinitely scalable, as well as the liquidity needs to be consolidated. Like I keep giving this example of, like, if you see the web 2 world today, the web 2 world is practically infinitely scalable. You can launch as many applications every other day. New websites, new applications are launched, more capacity, more servers are added into the system. But the current web 2 system is the internet of information. So information is very seamlessly interoperable. Like we are talking, like I am probably on UAE's network, and you are somewhere in the US internet, US's network, and these networks are connected with each other. We can create, share, and exchange information seamlessly. Same way should be possible with web 3 for value. And that's why like Polygon 2.0 is there. Infinite scalability. You can add as many chains, as much scalability into the ecosystem, but the liquidity is still consolidated with one single trust layer, or trustless layer, I would say, that is ZK, provided by the settlement layer of Ethereum.
So what's happening with how would you define Polygon 2.0? I was reading about it. It seems like there are governance updates, tokenomics updates, the POS moving to kind of, you've got the Validium, and then you've got the ZK EVM. Can you give us basically like break it down into a couple of components here of like what's actually happening with 2.0?
Yeah. So see, all the governance and token update and everything, these are just means to achieve that trustless and community governed network. But what the network is doing is very simple. Like if you see, like we started with the quest to build the layer 2 networks. So we have the Polygon POS chain, which we are like, because when we started, the approach was plasma. People used to talk about state channels. Then optimistic rollups came in, and we know the problems with optimistic rollups. They are like kind of a midterm solution. And then, but then, we, and every researcher in this industry knows that and understands that ZK is the end game for all of this, right? All of these trustless systems, or these chains, as you would call it. So
Sandeep, can you explain that real quick? Just like before we move forward, can you explain why optimistic is this kind of like short-term solution? Because if you look at the L2 space, most people are like familiar with optimism and arbitrum, and those are both optimistic solutions right now. So can you explain why ZK is the
Absolutely. So essentially in these layer 2s, what exactly you are doing is you are doing some computation on an off-chain environment, right? Which is like, let's say, the chain of optimism, arbitrum, whatever it is, right? And you essentially, with layer 2, what you want to do is you want to prove this computation completely on Ethereum, and you want to make sure that if the users stop trusting this chain, they can exit based on Ethereum only. They don't have to come to this chain. They can exit from Ethereum only. These are the two main things that you're trying to do. How optimistic rollups achieve that is, they say that, okay, you have to do computation on a separate side so that you can scale. But what you have to do is you have to still provide all the data back to Ethereum and the proofs of the state transitions. Why you have to provide all the data? And that is exactly why it's called optimistic, right? Optimistic means like there is nothing special that you are doing technology wise. It's a fairly simple technology. If you see, like, there is nothing special you are doing. What you are doing is optimistically assuming that the layer 2 chains are working fine. The single operator sequencer is working fine, but you expect the sequencer to put the data and the proof on Ethereum. And if something goes wrong, since all the data of the transactions is on Ethereum in a minified way, anybody can actually check if the chains are working fine. And the moment you find that there is some level of fraud has happened, or the code has been executed in a bad way, in a fraudulent way, then somebody can initiate. This is called fraud proof. And there is a delay of 7 days. You do a 7-day withdrawal period. That's why, when you use optimistic rollup, it takes 7 days for you to withdraw your money back to the main chain. The reason for that is that you need to give enough time for everybody in the community, and you assume that somebody would be watching this, and the moment they find some fraud in that, they will raise the fraud proof. That's why you need a 7-day withdrawal period. But if you see, as a technology wise, as I explained, there is a fairly simple technology. All the transactions are happening on layer 2. You put all the data back on Ethereum, and you put all the proofs back on Ethereum. That's why the costs are also fairly high for optimistic rollups, right? Because you are putting all the data back on Ethereum, even though it's minified, but you still have to pay. But in case of ZK, what you are doing is, ZK is without going into the details of ZK, what ZK is allowing you to prove a computation that you did just by providing me a kind of a constant size proof. Constant size proof means that which takes same amount of computation every time for me to verify. So let's say you are that chain, let's say Jason, right? And you executed 100,000 transactions. You don't need to give me the data of those 100,000 transactions. I don't need to know anything about that. All you need to give to me is that here is your ZK proof of all the previous, the current state, right? Current state to the next state. And you just give me the proof. I verify it on Ethereum. And the moment I verify, I am 100% sure that everything you did, it is correct. So you can already imagine the amount of scale you can achieve. Right now with optimistic rollups, you have to put all the data back on Ethereum. Whereas with ZK rollups, you don't even need to put the data back on Ethereum. You can have it off chain. And as far as that data has fair enough data availability, guarantees for you, you are fairly sure that this operator cannot cheat with it, because that ZK proof, the mathematical proof, will not allow. So you can say the trust model is, in ZK, it's fully being trusted by maths. In case of optimistic rollups, you are relying on some sort of socio-economic games that somebody from the community might be watching it and will raise the fraud proof. Another problem with that is, like, the optimistic chains. Let's say you have one chain, it's fine. Like, you can assume somebody is running a full node of the chain, and these are fast chains, right? These produce fast blocks, and running a node for a layer 2 chain, cost you around, let's say, maybe at least $2,000 to $3,000 or $5,000 a month, roughly, right? If you want to run all the chain to check for the fraud, right? So $60,000 a year minimum, I'm saying. You need to run a full node. Now imagine you have 10 optimistic chains. Now somebody from the community needs to run these 10 nodes minimum, and this is the minimum requirement. Otherwise, you are testing that guy only, right? And so that's 600K. If, let's say, this is 10, if it is 100 chains, now similarly the cost goes to $6 million. Somebody has to run, or as a community as a whole has to run $6 million worth of nodes to constantly check for those fraud proofs. So hence those socioeconomic proofs do not scale, especially for the app chains. They do not scale. Whereas in case of ZK proofs, you can have like millions and millions of chains. You don't care as far as the proof is being submitted to Ethereum. You don't care whether there's a guy who's sitting on a college dorm room and has built a game, and you are using that game, and you have $500,000 in that game. You don't mind that much, right? And same case, like, you can think about this app chain thesis, why it did not, Cosmos. Like, I love Cosmos community, one of my favorite projects in the ecosystem. But then Cosmos app chains do not scale because of this property only, right? Because you have like 10 chains, one of them has 100 validators, which is fairly secure, but others have like 5 validators, and all of these chains are connected with IBC. So if you are moving $1 million from this 5 validator chain to the 100 validator chain, the 100 validator chain needs to trust these 5 validators, because if there is a fraudulent, let's say, consensus fraud that happened on that 5 validator chain, now you are stuck with a $1 million, which is a bad value that came to you. In case of ZK, if both these chains were sharing ZK proofs with each other, it doesn't happen. And that's what is one of the main theses behind the Polygon 2.0 as we go along on that.
Got it. So what you're saying is all the governance changes, the tokenomics changes, changing Matic to POL, these are all secondary things that are, the goal is to move forward this ZK EVM network, yeah?
ZK EVM network, which has 2 key characteristics. As I said, the characteristics: first, infinite scalability. That you have You can have 10,000 chains in this ecosystem, for everything works perfectly fine as far as the ZK proof is going back on Ethereum. Second, unified liquidity, infinite scalability, unified liquidity. How you unify liquidity is, we have this LXLY bridge, which we are going to launch a faster version of that. Is all these chains liquidity is connected into one single bridge, so you can move your funds from one chain to another without going to Ethereum. Right now, this kind of interoperability you will get in let's say every 30 minutes, but then very soon you will have a fast aggregator layer, which we call the aggregator layer currently, or interop layer, where each chain can actually push their proof every 10 seconds. And every 10 second, once the chain has pushed the ZK proof on this aggregator layer, every other chain can simply observe the ZK proof and allow any kind of incoming or outgoing transaction value coming to and fro from this chain. So all these chains become interoperable at a time scale of like 2 to 10 seconds. And if you want to see like that, let's say I am on a gaming chain and I want to swap my game tokens against USDC on Polygon ZK EVM. So I do a transaction. This game chain submits a proof in 10 seconds. The moment this proof is submitted in 10 seconds, the other chain, let's say ZK EVM, now knows that this particular proof has come in from this chain. And any cross-chain transaction I'm sending, ZK EVM chain knows that, okay, this transaction is legit, is kosher. And, I do the swap. And then now the ZK chain submits the proof in 10 seconds. And now if I have a USDC going back to the gaming chain knows that ZK EVM has executed correctly, and it allows me to get my USDC back. So in 20-25 seconds, you are on a different chain. You don't have to bridge and all that stuff. You just do a one single trustless transaction, one or two trustless transactions, and you are done. That is the kind of, so what it starts doing is, all these chains then start feeling like one single block space. And this whole block space can have now millions and millions in TPS, let's say, millions in TPS over the time as these things scale. And if you actually, look back, you will see the internet has also scaled in the same way. And, from the Polygon side, like, we are not here to, create a project which is like, which happens in crypto cycles, that you have a project and, for one cycle, it's great and all that. No, like, we are very clear that we want to become, as I have also said, that, we want to become top 3 players or top 3 projects in the space. BTC, Ethereum, they have had a big impact on the world. And we want to be the 3rd project, after them, or like join a list of these projects which have that level of impact. That's the goal of Polygon. And there is absolutely no, compromise on that.
So Sandeep, extend this vision out like more than just 1 year. Like if I'm trying to get inside your brain for a second and like think about your maybe 5-year vision or something, I feel like where you're going with this is your vision of the world might be, you have this like ZK tech that basically makes it possible to prove a wild variety of things. Like maybe you could have Cosmos chains on Polygon or optimistic rollups. Let's say someone does decide to do optimistic rollups, they could still build on Polygon, right? Or
absolutely.
Yeah, Starbucks wants to build, and Uniswap wants to build, and College dorm room wants to build. This all happens on Polygon. That's your longer term vision? Yeah.
Our goal is that you have this block space, which is basically essentially everybody is trying to create trustless computation. I think that blockchains, the trustless computation is actually a much bigger phenomena. Like, we all think when we talk about blockchain, we talk about decentralization, but actually it's not the right thing. Decentralization is a means to achieve trustless computation. Now with Bitcoin, that trustless computation is payments, right? Ethereum, that trustless computation is any kind of generic program. So we all are trying to create this trustless computation environment. And as Polygons, to answer your question very specifically, that what we are looking for is that, imagine in 5 years from now, you have like, 10, 20, or like tens of thousands of chains, 10, 20, 30,000 chains, which are all like, which can be layer ones, which have their own tokens, which are validiums, rollups. You can define them in 2 big categories, validiums and rollups. Rollups means you are putting your data also back on Ethereum, and validiums means you are having your data off chain. So you can be a layer 1, nobody cares, right? You can be a layer 1 having data on your side, but you're still proving back on Ethereum. So there is the baseline of security for everyone is, the moment you receive a proof of a chain on Ethereum, you know that that execution till now is perfectly, it has been done perfectly. There's no fraud. So the in 5 year long goal would be that you have these tens of thousands of chains, all of them connect back into Ethereum, settle back into Ethereum using these ZK proofs, and there is cross-chain interconnectivity possible with them. And this is also infinitely scalable. Like, from 20,000 it could go to 100,000 chains, it can go to 500,000 chains. This architecture that at Polygon 2.0 that we have proposed, it will still scale. So that's the main point. And then if you ask like some of the researchers in the space, they would tell you that this is probably like, very bold, but also one of the most practical, architectures, which, whether it's Polygon or somebody else, but whatever comes out of this would look very similar to this. When a protocol comes out, or a project which becomes the mainstream Web3, or become AWS of Web3, everybody's using them, they will have something similar in their architecture.
Yeah. So what you're really implying is this isn't just the end game for Polygon, but this is the end. You think this is the end state for what infrastructure should look like?
Absolutely, 200%.
All right. So I would describe Polygon as like a side chain, I think. Maybe is the word to use right now. And you're moving
Polygon
to this.
POS. That's our biggest branding problem, that Polygon POS. Until the time we recently announced that Polygon POS will be upgraded to ZK, till the time we upgrade it to that, Polygon branding will have this problem. Like, people think Polygon POS is a side. Polygon POS is a side chain, but Polygon ZK EVM, for example, is a full-blown layer 2. It is as layer 2 as it gets.
Okay.
Right?
True. So, but you keep, so then why? So you're moving to the ZK EVM Validium. This is where some of the technicalities go beyond me, but would you ever think about becoming a full scale rollup? Because the way I understand like a full scale rollup versus a Validium is there's slight differences there, like you were just explaining. Yeah.
So Polygon POS will always remain a Validium because it has its own validators which are storing the data.
Right.
But the ZK proofs are implemented, it is putting the ZK proofs back on Ethereum. Till that time, currently, let me explain again. Currently, Polygon POS is a side chain. It has its own validators. It just puts a checkpoint back on Ethereum for the current state of the chain. Once the ZK proof plugs back into the Polygon POS chain, because the data is still managed by the validators, Polygon POS becomes a Validium, right? But Polygon ZK EVM is a separate chain which puts both the data and the proof back on Ethereum. So that's a full-blown rollup. So the Polygon 2.0 architecture, which is a multi-chain architecture, it will have Validiums, it will have rollups. Who knows? Like, as you said, like, it might have Cosmos chains, which are back on Ethereum. It might have some layer ones which are proving back on Ethereum. So that's what it's about.
Got it. One last question on this, then we can move past it. Right now, you have how many validators do you have? Like 100 validators or something?
Yes.
And they control the bridge back to Ethereum.
Yes.
That will change with this, right?
That will become trustless. Then the validators don't control the bridge.
Got it.
They just control the sequencing of the transaction.
And
why that is also important is that think about the current layer twos that are there, which includes Polygon ZK EVM, includes Arbitrum, includes Optimism. Why, I think we, the Ethereum community has not discussed that much because, we try to follow the narratives. But actually, if you have a single sequencer chain, and which is let's say very big in DeFi, right? For example, base chain. Now imagine on that base chain, or I am Polygon ZK EVM, or let's say I am Arbitrum or Optimism, and there is a high volatility period in the market where there is 100 million loan from my team only. Let's say whoever is running the sequencer has 100 million loan on Aave, which can get liquidated because of the volatility period, right? And now there is an incoming transaction from an oracle which is changing the price, which is like updating the price. I can simply, for that, the blip where the wick goes below and then comes back, I can simply censor the oracle transaction at that point in time, so that my loans are not liquidated, and then bring it back. So for the DeFi chains, eventually all these layer ones, for now it's okay. People are trusting the sequencer team or the project team that they are running it, okay. But eventually for DeFi, at least, if a chain wants to be layer 2 chain, wants to be DeFi chain, they need to be decentralized, so that If one sequencer is not accepting Oracle's transaction, in next second or 2 seconds later on, other one will accept that. So with Polygon POS, I think that it will become the first layer 2, which is fully decentralized once it gets updated. Hopefully, it becomes first, but maybe by that time some other layer 2 also is able to launch something decentralized sequencing.
Who do you think of as your, like, if I were sitting in your shoes thinking about my competitive set, I'd probably put it in 3 buckets. There's Optimism and Arbitrum. Then there's probably like Coinbase. There's like Base, right? And then there's these like ZKs that, talk about the tech, have like supposedly really good technology, but maybe haven't gone to mainnet yet even. And, maybe 2024, even 2025 will be the big years for them.
Yeah.
That's kind of like how I would see the 3 competitor buckets. I'm curious if you see it like that, and maybe who you think of as like your main competitor there.
Yeah. So from the Ethereum community, then in Ethereum community right now, we are like, everybody is at such an early stage that, thinking that on Ethereum community, we try to at least maintain that mindset that anybody who's scaling Ethereum is fine. Like we are also hardcore. Right. So, but if you ask me the competitors, I would say anybody who's providing trustless computation is a competitor to each other, right? So because the target addressable market is the same. Like everybody who's looking to build either in DeFi, either gaming or whatever, they are trying to build that's why I said trustless computation is a much bigger phenomena than this decentralized blockchains that we are talking about. And anybody who's building that trustless computation engine is in a way is a competitor. So ZK, optimistic rollups, maybe some other approaches that might come up, they in a way are competing with each other.
So if I'm a founder listening, let's say I'm a founder listening to this. I just raised my seed round and I'm looking to maybe, I don't know, I'm dabbling, and I'm trying to figure out if I should build on Base, I should build on Optimism, Arbitrum, Polygon, Scroll. How do I make that decision?
Yeah. So if it depends on so many things. Like if you are a long-term founder, like you are building an application and you believe that this will be a big application in 5 to 10 years, then you have to see. I actually look for 2-3 things. Like I would look for the users, maximum integrations, like which particular chain has maximum integrations into various exchanges and various liquidity providers, on ramp, off ramp, which chains have better. If I'm building DeFi, for example, which chain has more liquidity, right? If I'm building a gaming application, which chain has more of these gaming communities where I can get the early users and things like that. But then in the short run, as a founder, many people also look for novelty factor, for example, because in this market, like all people reward is some sort of novelty. So right now, maybe base chain is a good example, good option, where like for the first 2-3 applications, 5 applications who will launch there, they will have this novelty factor. Once those have launched, then it kind of goes away. Same will be applicable to any other chain which are doing the airdrops, like upcoming airdrops. For example, Arbitrum had a massive airdrop, and that kind of incubated a lot of projects in their ecosystem. So similarly, that I feel that will happen for Scroll and other things also. And maybe if Polygon is launching some other layer 2s and things like that, maybe their novelty factor would be there. So those kind of things, but depends on, like, if you are building DeFi, you would want to choose for liquidity. If you are building gaming, you would want to choose for distribution to gaming. If you are building something like social and all that, you would want to have distribution to normal like crowd.
All right, everyone. Wanted to talk about Vouch again, our favorite insurance provider for crypto companies. If you are building in crypto, you have probably come to realize that contracts need insurance, partners demand insurance. And as a founder myself, trust me when I say you owe it to not only yourself, but your investors and your clients and your customers. And I'm not just talking about any insurance. Their exclusive coverages are tailored specifically for crypto companies that can address issues like protections for regulatory defense, recognizing DAOs as insured, addressing smart contract vulnerabilities, and even covering the loss of digital assets. They're in it with you, whether you're working on L1s, L2s, DAOs, MPC wallet providers, building a protocol, and a lot more. So whether you're just scribbling your next big idea on a napkin or gearing up for a big fundraise or maybe thinking about that IPO or an acquisition, don't leave things to chance. Get insured today with 5% off Vouch's exclusive coverage for Empire listeners using code EMPIRE. Think about it this way. With Vouch, you're not just insuring your startup, you are investing in peace of mind. Hey everyone, we'll get back to Empire in just a minute, but before we do that, I want to let you know that we have Permissionless coming up. Permissionless is a big conference that Blockworks and Bankless put on together. It is the biggest, the best DeFi conference in crypto. This year, it is in Austin, Texas, September 11th through 13th. If you've been in crypto for a while, you know that bear market conferences are the best kind of conferences. We have a phenomenal lineup of speakers. A lot of the guests that you hear on Empire are both going to be speaking there. You will have the opportunity to meet them there. And a lot of the topics that we cover on Empire, ZK Tech, rollups, account abstraction, MEV, app chain thesis, a lot of that kind of stuff, that will all be discussed at Permissionless this year. So because you are a listener of Empire, you get a special discount. That's right. Santi and I negotiated with our marketing team. You get 30% off if you go to blockworks.com/permissionless. Empire 30 is going to get you 30% off your ticket. Today, when I'm recording this, that's about $300 off your ticket. So type in Empire 30 when buying your Permissionless ticket. You get about $300 off. Click the link at the bottom of this episode. It's in the show notes. Do it quickly because prices go up all the time. And if you are going to Permissionless, hit me up, let me know, shoot me a DM on Twitter. I would love to meet up with you there. You want to talk about tokenomics or governance?
I can talk about tokenomics also first, because this is a question from many people that we actually when we rebranded from Matic Network to Polygon, at that point only we had said that this is due on us, that we need to upgrade the Matic token, which was a single chain or token chain or single chain token. This will migrate into this multi-chain environment where multi-chain tokens are there. So I think on that front, what we have built is basically, we believe that this POL token is upgradation of Matic, and that upgradation allows it to become multi-chain, right? And also allows it to kind of serve this whole multiple chain environment. Like what I mean to say is that previously, like, I think, and that's why we call it a third generation token, because if you see the first generation token BTC, with BTC as a holder, you have no way of holding BTC and with that contributing into the network. Like, you cannot stake that network, you need to have miners, like, which is separate separate setup to contribute into BTC. Then came Ethereum, especially after the merge. Now, if you are an Ethereum holder, you can participate in the network for securing the network. And then Polygon kind of tokens will be these third generation tokens, where you can actually secure multiple chains in your ecosystem. So not only you can validate and earn rewards, transaction fees from one chain, you can earn transaction fees from multiple chains. And the second part is that you can also play multiple roles in Polygon ecosystem. You can be a validator or a sequencer, you can actually be a prover, you can actually become a data availability provider, and you can also be an aggregator of these proofs. And we expect that for running this whole large trustless ecosystem, this will generate a lot of transaction fees, and that will go to the people who are for the POL stakers, which will be running these chains and different kind of services. So you can also think that POL has kind of like as popularized by eigenlayer, like restaking, but we call it like multi-staking, like, because eigenlayer restaking is built on top of Ethereum protocol, whereas this multi-staking mechanism is built in protocol in Polygon. So you stake once, and then now you just can subscribe to multiple chains.
It lets you become a validator for multiple Polygon chains, yeah?
Yes.
Okay.
If you want. So if, let's say, you are a validator node, Jason, then you can say that, okay, this new chain is coming up and this is run by, let's say, Base, like Base is being run by
Sure.
Coinbase exchange. Let's say some other exchange is running, and you would say, okay, I would like to be a validator on this chain. And then you pick and choose that chain, that kind of stuff. You can.
And the other thing it does that I don't think you just mentioned is it so you guys have this 10 billion
Yeah.
supply cap, right,
Yeah.
on Matic, which is now going to become POL. You guys are switching to an inflationary model, right? To
Yes.
I think this is to incentivize validator participation, and then probably also just continue funding the treasury
Yes.
in maybe a better way. But what's the rationale behind that?
Yes, yes. So as I said, that the Matic is moving from a single chain token to a multi-chain token. So we need to have initial validator incentives, which can actually incentivize people to run and validate multiple of these chains. So which means, what it means is that in that case, we have a provision for 1% of addition of this fees every year, 1% every year, which is less than, let's say, I think Bitcoin is 1.8%. Ethereum's also minting is, but Ethereum also has burning mechanism, but I think it's more than 1.52% or something like that. So it's very, like, kind of a low but base security rewards for the validators. Like, we all discuss that if BTC, if it the rewards keeps going down with every halving,
Right.
what is the incentive for the validators to, or miners to run that? So that is one part. Then secondly, we have also provisioned for a limited amount of time, from for 5 to 10 years, to have 1% of the treasury in POL token, which can be used to further grow the ecosystem,
Hmm.
right? And the reason for that is that you see that every other, like, quarter, actually, some new layer 2 token is launching with a fresh treasury. And what happens is that all these, like, for example, Arbitrum, Optimism, when they launched, they, like, the markets assign them a value based on keeping, let's say, Matic token as a, like, originally, when it was the only kind of layer 2 protocol available, the kind of assigns a value around that, right, like in the market cap. And now you have other layer 2s like Arbitrum and Optimism, being there. The third one will, whatever protocol will launch their new token, they will also get assigned somewhere there. And those protocols have, from day zero, then billions of dollars in treasury. So it kind of puts the treasury or Polygon ecosystem at a kind of a handicap, where other ecosystems have much more money to incentivize and grow the chains, grow their kind of ecosystem. So that's why we kind of provision 1% per year for next 10 years, and the community can decide, like, if it needs to be 2% for the first 2 years, and then 1% for next 6 years, or 2% for 5 years. All that is flexible. But the point being that the treasury or the community needs to agree that, okay, we need to have, till the time in next 3 to 5 years, when these infrastructure wars are going on, Polygon is not handicapped. Polygon community ecosystem is not handicapped to keep acquiring more and more developers to it,
Hmm.
because no other protocol can also kind of spend more than 1.5% of their treasury legitimately, if they don't want to experience a huge amount of sell pressure into the markets. So it kind of puts Polygon at par with other chains, especially who are launching with the new token, because Polygon is like 4 years old token, 90% of its supply is out, and all those things. So the ecosystem needs a way to sustain and secure and keep growing on the distribution and adoption front.
Yeah.
So hence the rationale.
On the governance side, I mean, we can talk about it quickly. It seems like you guys are basically breaking into three main governance pillars, right? Which is protocol governance, system smart contracts governance, and community treasury governance.
Yeah.
Why is this the? I'm curious, like, what learnings in the last couple of years led to this kind of three
Yes.
pillar model?
Yes. So like, the one is the protocol governance, right? If you see Ethereum and Bitcoin, they are not, their core protocol and client development and core things are not governed by the community, right? Like, but they are, like, Ethereum, for example, has a core devs group where everybody can join, anybody can join, they can raise their opinions, and there is a rough consensus off chain that happens, and then people upgrade the clients, and other validators also have to upgrade the client. That's the way these are governed. So some of the parts of that, those kind of protocols, we don't think, I think Bitcoin and Ethereum have proven to have a very good model, and you don't need community governance on that, like, where the token holders, which have no understanding of those hardcore technology details, because we want to be real with the governance. Like, we don't want to call it governance for the sake of calling it governance and asking all the people to vote on things where most of the people have don't have much understanding. Then you have the protocol smart contract governance, which are the smart contracts which are being like all these layer 2 smart contracts where they have the bridge contract and all those things. So there, the community, if there are any kind of further any kind of upgrades that are coming in, we can actually take the vote from the community, or put a time as they call, like time delay into that time lag. And with that, any kind of upgrade is going, it has a, let's say, 7 to 30 days period where community can review and say, okay, this change is going in, this affects the security, everybody take out their money and all that, right? So that's a governance mechanism. So no change can go immediately. But for the state of layer 2s, as you see, like, these are smart contracts. Every other day DeFi smart contracts get hacked and all that. And those kind of things, with those kind of contracts, nobody can tell in advance. So we also will, and all the layer 2s have this security emergency upgrade community, or security committee. All the layer 2s have, like, in the past you must have seen that Polygon POS, a lot of people said that, oh, this is a multi-sig and all that. It's just that we did not brand it more fancy. Like, all layer 2s, big, small, supported by Vitalik, whoever it is, everybody has that security
Yeah.
committee. But again, it's the power of narratives in crypto, and people kind of people who
You
did
you
not
guys
like
have
that.
had a couple of those narratives go against you, like the
Yeah, yeah,
sidechain
yeah,
narrative. Yeah, yeah. So,
yeah. It's the same
yeah.
thing. Like, right now, for example, like, I mean, again, uh, you know we don't want to, like, call those things out, but actually, if you see optimism without the fraud proofs, or base chain, for
Mhm.
example, without the fraud proofs, and they are single server side chain. At least in our case, there are 100 validators on that side chain. These are single server side chains, right? So, but again, like, no shit towards optimism and base chain. Like, they have been trying to build their part, right? Like, whatever, we were also trying to build our plasma part. But then, obviously, when you have teams from the Silicon Valley and supported by large VCs and all that, it's easier to form those narratives and kind of bypass. Imagine if Polygon had done something like that. You also are remembering some of those narratives going against. If we had done something like that, let's say we launched our ZK proof without the proofs and say that ZK proofs will come later on, like, we will be killed out there, right? So, that's the advantage of being from the Silicon Valley and maybe US and all that, and having the support of a lot of institutional investors and things like that. But that's perfectly fine. What I was saying is that, yes, coming back to the governance, that the smart contract governance, community vote can also be taken, but mostly it will be actually the time lags that will be implemented, and community will have the way to review. But this will be off-chain governance. And then there is this third part of governance, which is the community treasury and all that. There again, we want to involve community on, like, right now, till now, you must have seen that Polygon Labs and some of the other parties in the system or in the ecosystem, they are actually doing a lot of BD work and things like that. Like, now with this treasury, we want more and more community to be involved. How they will be involved, as per the compliance structures of US and all that, because the regulation on DAOs also keeps on increasing, keeps on growing. And I think largely everybody understands that, if you have a pool of money which is controlled by token holders, that's not considered very this thing. But we have to find out a way where the community is fully involved in taking some of these decisions, growing the ecosystem, and we are able to do it in a very, very compliant way.
Yeah. Sandeep, anything else on Polygon 2.0? Because I want to move to another topic, unless there's anything else.
Yeah, I think, like, we discussed most of the part. Like, yeah, we discussed that infinite scalability and unified liquidity with that aggregator layer. I think we discussed most of
Cool.
it.
Um, the other thing that I think people know Polygon for are these like big BD deals, right? Like
Mhm.
who are some of them? Starbucks,
Yeah.
Meta, Stripe, Adobe, Adidas, DraftKings, like some, Reddit, some of those big names. I'm curious, like, I was looking at the TVL on Polygon, and it doesn't come from Starbucks, no surprise,
Yeah.
and Nike and folks like that. It's Aave V3, it's Aave V2, it's Uniswap V3, it's Curve, it's Balancer, it's Compound, etc. It's the names
Yeah.
that kind of you would expect. So I'm curious, looking back like a year and 2 years later on some of these deals, what are your learnings? Maybe like the pros of doing these deals, and then the the unexpected like negative downsides of doing these deals.
Absolutely. So again, like, this is one more part where Polygon is stuck with like kind of narrative,
Yeah,
part.
yeah.
But let me ask you this question: for a proof of stake protocol, what do you think is more important, like TVL or the transaction fees generated on the network?
The transaction fees on the network.
Exactly, right?
Yeah,
Because TVL has no, like, TVL matrix as a matrix is just a leading indicator that this chain must have a lot of
right, right.
thing going on. But imagine if we have an Instagram chain or Instagram on our chain, and Instagram is generating $10 million of transaction fees. That transaction fees is going to the protocol token
Right, the transaction
holders.
fees are 10 times more important. No, I agree with that. Yeah,
Exactly. So all these deals now you, if you want to open, let's say, open CryptoSlam and go to 30-day view on that and check that, as per 30 days, which are the top, what is the top protocol there by volumes. I'm saying, like, I mean, I don't want to actually say the this part, but I'm just saying on the volumes by this one, like, check the top three.
what DMarket, Board Ape Yacht Club, DraftKings,
DraftKings. You see,
DraftKings.
DraftKings actually is
Yeah,
number.
yeah, yeah. I see what you're saying. Oh, 680,000 transactions, 30 days,
Yes.
up 113%, 14,000 buyers. I see what you're getting at.
So,
Yeah,
so basically, and now check, like, just Google like Reddit number of NFTs on Reddit.
right.
There are 16 million NFTs that have been generated by Reddit holders with a on-chain non-custody wallet, which, and the chain, these NFTs are minted on-chain. So 16 million transactions were done by Reddit,
Hmm.
which actually would have given easily, I think, a revenue of roughly 250 to 300K to the Polygon validators,
Hmm.
right? That is the part that should be like, but only problem is that, we only care about the speculative use case, like Nike swoosh, for example. Check Nike swoosh, what Nike swoosh is doing. Just later on you can Google how many holders they have
I
and
know
how
I
much.
saw it. I'm in a group chat with some of the Nike crypto. I mean, yeah, they're
Right. So
yeah,
what I'm trying to say here is that, because the whole narrative, and again, we don't have that narrative power in the, on Twitter, because we don't have like those influential investors who can actually talk, and then it becomes narrative, right? If we say, nobody, people say, okay, we are saying because we
right.
are biased. But basically what I mean to say here is that Lens protocol, for example, the many of these protocols might not have a lot of value trading on the chain, but they will be generating a lot of transaction fees, which is the most important part for, for Polygon. But also, I would also say that, that value is definitely the leading indicator of how much, activity is there on the chain. And I would say, if you go to the TVL also, even though Polygon has not done any sort of liquidity incentives for last 2 years, you still see like Polygon, after, like, in the Ethereum ecosystem, it's Polygon, Arbitrum, and then
Yeah,
Ethereum, Arbitrum, and Polygon.
yeah,
That's
yeah.
the Polygon number three. And that also, Arbitrum recently, like, in the last 4, 5, 6 months, they came up because of the, like, obviously they have a great community, but also airdrop and whatnot. So what I mean to say there is that there is a lot of traction there. And you should also, like, one more thing, like, Jason, I would say that if you go to the main page of this CryptoSlam, if you go scroll up and just go to the main page,
Oh, yeah,
and
yeah.
yeah, here, yes,
Uh,
the home page, just click on CryptoSlam logo.
yeah,
Just click on CryptoSlam logo. Oh, and then go to the chains. Basically, there is on the top you have rankings. You
yeah,
go to the
yeah.
rankings and chains, blockchain rankings, and then you do 30 days. Basically, just do a 30-day average of that. You see where Polygon is,
Yeah.
and
So for anyone
you
who's
just,
listening, you've got Ethereum's number one and Polygon's number two. Then it goes
yeah.
Solana,
and
Mytho.
and like,
Yeah.
actually, one could argue that Solana had, like, I think in the recent times, like, only NFTs going on over there, right? And then Polygon community actually, like, in the NFTs started like 6, 8 months back, last year, November, December. And a lot of projects are doing well,
Mm.
and projects are doing well over there, and it's claimed. And you already must have seen on the DeFi side. So on the DeFi side also, TVL wise, after Ethereum, Arbitrum, it's Polygon. So you
Right.
see, NFTs rank 2, DeFi rank 3 in Ethereum ecosystem. Gaming, Gaming, I don't even know like how many people know about gaming because gaming, nothing in gaming has actually exploded. But in terms of the games building on Polygon, especially with the immutable X, which used to be like the number of, they have like 150 to 200 games building on them. They completely migrating over to Polygon. Polygon is like probably from the rank 2, it will be easily around 1 to 2 orders of magnitude, like orders of magnitude. I'm not saying
Mm.
2x 3x, I'm saying minimum 10x, and up to a like 90%, 90x also, from because the rest 10%, I think Polygon has like 80 to 90% of that market, and 10% is distributed between like various layer 1 layer 2s and things like that. Very little gaming on that. And most of these games, there is also this interesting stat, maybe I can share with you later on, which says that in 2022 there was around 1.4 billion, 1.5 billion dollar of funding in the, or 2.2 billion dollar of funding in the web3 gaming space. And if you consolidate the numbers and extrapolate them, you will realize that around 80 to 90% is Polygon and IMX
Mm.
ecosystems, and Polygon alone is like around Ethereum. So if you see like multiple and brands, the fourth segment I was talking about, DeFi rank 3, NFT rank 2, gaming absolutely rank 1, like there's no even, not even second on that. Brands, no second in that. All most other brands are Polygon. So if you see in terms of adoption, like we are actually very focused, and I told you the why of Polygon is only about adoption. Like we don't, we believe, I should not say we don't care about the narratives. We believe that eventually these narratives will subside
Yeah,
and the
yeah.
fundamentals will matter. But right now, the all the money in crypto space is basically on social layer. There's nobody cares about this.
Yeah, of course. Yeah. Yeah. What do you think of decentralized social, like Lens and Farcaster and what's happening on Friend Tech? I'm curious, what is this I know you're very bullish on gaming. Is social something you're excited about or not really?
No, I am excited about the social side, where I feel that there is something there, but not like this. I mean, whatever gets popular or viral, actually, if you see that, and that's the whole, kind of what I say, misfortune or unfortunate. That is very unfortunate for the industry, that even now, any use case that becomes viral, that has some speculative angle to it, right? So like where people are trading these things and all that, like I don't think like social, with only these games will become
Yeah.
really big. You need to have like some fundamental value being delivered to the users. On top of that, like of course there is native money, you can add some other things. So I feel social to become really mainstream, crypto social to become really mainstream, we are some years away from that. I'm very bullish on Lens protocol, for example. Obviously, they are, because
Yeah.
they are, I'm biased because they're built on Polygon. But I think Stani knows like he's actually building an ecosystem around it instead of himself building like few
Right,
apps
right. No, I agree.
ecosystem. So it can slowly can start getting network effects. And the thing with these things is once they go viral, they really go viral.
Yeah, agreed. Um, as we think about wrapping it up, Sandeep, I just want to zoom all the way out. I have a almost a non crypto question for you, which is if let's say you were in a room, let's say you were in a room with maybe 500 institutional investors and execs from Fortune 500s and stuff, and none of them really understood crypto, and they asked you this one question. They said, Sandeep, can you explain to me the business model of Polygon? And they don't know crypto. How do you think about explaining that to them?
Yes. So when you say business model of Polygon, is the business model of protocol, not the Polygon. There is no Polygon Labs is a company, and it is also non-profit. It does not generate profit, right? It's a part of the foundation only. So there is no profit that comes to this. What happens is that you are building a protocol where both demand and supply is outside of you. Demand. What is the demand for? Demand is for trustless computation. Whether you are doing in a decentralized way or you are doing in a single sequencer way, that you are just providing trustless compute, and you have these third party developers who are on the demand side, who will be using these services, and they'll be paying transaction fees for various parts of the network. Who will get this transaction fees? That is the supply side, and that also is outside, like where you expect the community and the whole, like people from the whole world to join this protocol and run various different kind of nodes or services, which which will be served to these demand side people who are looking for trustless compute. And in this between, whatever transaction fees is being generated, that goes to the supply side people, that is people who are running the nodes. Now, how does it connect to the overall, let's say, token ecosystem or whatever? Like, for example, if in case of Ethereum, how does it connect to the value of Ethereum? Is that all these, or in case of Polygon also, all these validators, they stake, they have to, because they have to provide these services, there needs to be some way for them to act, or their incentives to be aligned in the direction of working positively towards the network. So they stake these tokens, and these tokens, stake tokens, determine how much gas fees or how much part of the transaction fees they take. The larger number amount of demand here, which is generating larger amount of transaction fees in the network, the more your validators of your token holders who are becoming your validators, they are going to generate that fees. And ideally, if that fees, let's say today, if 5% is a US Fed rate, if today your network is generating $100 million in transaction fees, right? So ideally, your token should be valued minimum 20 billion. If 100% of that is staked, minimum $2 billion, because that's like 100 million is 5% of the of that fee. So people are like staking that amount of capital to earn that 5% yield yearly on that, right? So that should actually how it relates to this. And then some of the tokens are owned by all the projects treasuries and all that, and they have to use it till the time the projects reach an escape velocity, and from there the foundation also can dismantle itself, the project becomes
Right.
ossified, it goes. That's how, like, there's no business model for these, like there's no money making for the teams who are building it. All their incentive is in those tokens actually, that if those tokens appreciate in value, probably the founders will also get something,
Right.
if at all.
I hope you would get something, Sandeep, if you guys if you guys accomplish this.
Yeah, hopefully,
um,
it's a
hopefully,
long
man.
time. Yeah.
The last question I had for you is so Mike and I spend a lot of time like thinking about just getting inspiration from other businesses outside of crypto, right? Whether that's Bloomberg or other media companies or data platforms or whoever it may be. I'm curious if there are businesses outside of crypto that you look to for inspiration.
Outside of crypto, businesses, I think, like, off late, what I see is like crypto is so speculative in nature, right? Like, I actually have started appreciating the normal traditional business model where people have like, you put input capital and you build something around it, like you build a factory, you build something, and then you are generating revenue out of it and hope that revenue minus cost is positive. I appreciate those models also these days more,
Yeah.
because there's like so much of speculation in crypto, and we are trying to build this decentralized ecosystem where community participates, and everybody participates. But then the thing is, there are very very small part of our community is interested in things which are not speculation, so which is like kind of a hard and unfortunate part of our thing. And I think we need to do well on that, because let's say in 5 years from now, you still have to invite people like me who are building infrastructure for these podcasts. That means we have failed as a collective. Like, you should be inviting apps.
Need the apps and the consumer things. Yeah, yeah. No, I agree. So
Anything more, like, you want to ask from me, controversial and all that will be more fun.
no, no, I think this is a good overview of Polygon 2.0. Good chat about kind of the L2 wars, infrastructure wars that are going on. Interesting getting your take on some of these like BD deals and yeah, man, great
Yeah.
conversation.
No, and one more thing, I think I just this thing is that we have also launched this Polygon CDK, which is basically the consolidation of all the Polygon technology, which can be used to run your own chains, like run your own ZK chains. Like, this has been already there. A lot of players like IMX and IDEX and so many applications and so many Palm network and all that. They have announced that they are building their ZK chains using this. But for us, we had to, we wanted to bundle it into one single package. So Polygon CDK would love people to check that out, especially the founders to check that out. Like, you can build your own ZK chains, which can be completely sovereign. You can have like ZK proofs, which provides you like 5 to 10 minutes or half an hour, maximum half an hour movement to and through movement of the funds, liquidity from Ethereum to from Ethereum to your chain, which is not possible with optimistic rollup chains. For example, you have a 7-day withdrawal period, and for the larger chains, they can have these fast withdrawal services. But for app chains, like it will be very very
Right.
hard for you to provide fast withdrawal services. So that's a very big advantage in that mode. So no 7-day withdrawal period. And second part is that these are future proof. ZK chains are definitely like more future proof, and more scalability is coming to that, because provers are like Polygon provers, for example, are very very efficient. So it's like hardly any cost for you. So I definitely recommend founders to who are looking to launch their own app chains, do look at the ZK technology, because technology is fairly mature for you to launch your mainnets with that. And also, this is the only path that will provide you interconnectivity, like using the Polygon aggregate layer also will provides you the interconnectivity or liquidity aggregation, or seamless movement of liquidity across chains. So if you launch
Hmm.
with this, let's say with Polygon network, your liquidity or your chain's liquidity is connected across multiple chains, so people can move to and fro without even coming to Ethereum, their funds. And in future, as I explained at the start of the podcast, that you would be able to have cross chain transactions in a matter of like 2 to 10 seconds, 15 seconds, which is almost like all these chains start feeling like they are one single.
That's great. Sandeep, man, a pleasure having you on.
Thank you, sir.